Apple's fourth straight record close ahead of the earnings report on Wednesday. Shares of Microsoft higher after scoring a major victory against Amazon, winning a $10 billion contract with the Pentagon for cloud computing services.
Plus, Tiffany's surging today after the owner of Louis Vuitton offers to buy the iconic jeweler in a deal worth $14.5 billion. Shares closing up about 30% on that one.
All right, as we wait for Alphabet, that's the big earnings report today. Let's bring Scott Martin in from Kingsview Asset Management, a Fox Business contributor. Also joining us is Doug Flynn from Flynn Zito Capital Management. All right, gentlemen, welcome. No Alphabet that I see yet, Scott. So talk to us about the S&P at an all-time high and the NASDAQ almost there. What's driving things here?
Well, I think things just feel good, Connell. You guys kind of talked about it in the lead-in. It's funny, we're at, multiple record close as far as many of these we've had this year, but this one feels a little different, doesn't it? I mean, we've been through so much, I say that kind of collectively in our relationship, in the S&P in the last 3 months. Impeachment, China trade talks falling apart and then reigniting, certainly concerns about a recession. We've had concerns about earnings, which have all fallen kind of by the wayside for now. So to me, the market has this little, say, buoyancy to it right now, and we're getting that follow-through from some of these big tech companies that I think we're going to see in Google here shortly that are reasons to go out and buy the S&P and NASDAQ as we go into the fall quarter.
I was about half listening to you, Scott, as I looked for Alphabet, and I thought you were talking about...
Not there yet.
I thought you were talking about our relationship.
That's more than usual, though, so
yeah,
thanks.
That's pretty good, actually. I thought you were talking about our relationship, then I realized it was the relationship you have with the stock market. Doug, is Scott right that it feels different this time to be hitting all-time highs? What do you make of where we are?
Well, I feel like this is the fifth time we've actually hit all-time highs over the last, since January of 2018. The market's up maybe about 2% from there. So we keep hitting these highs, but we need something to really break through it. So hopefully we'll get some earnings pickups from here. You're going to need that to further propel the market. And I think that would be the difference. If we can get on the other side with all of the indices and then something positive, maybe some trade talk finally coming through, and some other things that'll impact the earnings going forward, that's where you'll see us break to the positive.
I will say I think we've reset, Scott, a little bit, maybe, our expectations with regard to trade, that nobody's necessarily hoping for some sort of big comprehensive deal. Now, it seems maybe investors would be satisfied with something a little bit smaller. What do you think?
Yeah, totally. And I think, Connell, too, we've reset our expectations as far as earnings. I mean, going into this quarter, we were, looking at 0% maybe growth, maybe even negative, and the market is delivering better than that. Yet we were getting that expectation, and the market wasn't that far off of all-time highs. And so any kind of positive news, to your point on trade, certainly, or let's say no bad news, and some good earnings news mixed in there, the market wants to go up on that stuff.
Doug, make a final point on that on the earnings front, because Scott is right. I mean, almost every company, it's almost 8 out of 10 in the S&P 500 are jumping over a bar. But to be fair, again, it is a lower bar than we're used to here. So almost any beat does. We'll see how Google does, but just about any little beat can do for these stocks. I mean, is it kind of misleading, or what do you make of the expectations versus the results?
I don't think it's misleading. I think, 25 years of we're at the 25-year average of the PE ratio on the S&P, slightly above that. We're not overpriced by any stretch of the imagination, so there is room here.
All right, let me interrupt you for a moment, Doug.
Looks like a miss on earnings per share, $10.12. Go ahead,
If that number's comparable, it would be. Yeah, that's the first headline to cross on Alphabet, $10.12. We'll wait on Deirdre for a comparable number versus the estimate, which is $12.42. I will say the revenue is pretty much in line to a little bit better, $40.5 billion in overall revenue versus an estimate of $40.32 billion. So that's up about 20% from where we were last year. And the other thing everybody's looking at are these, what they call the traffic acquisition costs. And that's
$7.49 billion.
Just above the $7.46 billion that we expected. What's the stock doing? Down 2.5%. Doug, I interrupted you, but what were you thinking about Alphabet? What was the big thing to watch for a company like this from your vantage point?
I was looking at the two things. I was looking at the revenue, how far above $40 billion were we going to be, and I was looking at secondarily how far below $13 were we going to be on the earnings per share, and that's the real big miss there. So that's a concern. Listen, they have a lot of pressure from Amazon on their recurring revenue front going forward, taking away ad revenue. They have a number of pressures.
Let me add that in, actually, because it looks like for the quarter, advertising revenue, $33.92 billion. Network revenue, $5.27 billion. Average cost per click versus same quarter of previous last year, down 2%. Just throwing some things out there.
And the other thing I'll say, just to follow up on what Doug was talking about, so we're clear, we don't, at least, and someone can correct me if I'm wrong on this, we don't know how that earnings per share number compares to estimates. There may be something there that's taken out for accounting purposes that puts Alphabet in a better position. The stock's pretty much flat now, but go ahead, Scott.
Yeah, and Connell, there probably
hold on,
is.
Scott, hold on a second. Deirdre was going through that. That's what we were waiting for, and she joins us now. So, all right, Deirdre Bolton on the floor at the New York Stock Exchange. What do we actually see here,
All right, so
Deirdre?
still trying to compare this earnings figure, making sure that it's apples to apples. So I'm going to wait a few more seconds on that, but I'm going to go with what you guys are reporting. Of course, $10.12 a share. But again, I'm still trying to see if that matches. I'm doing a little calculations on the side here. Back of the envelope, back of the phone. But revenue is a clear beat, right? $40.5 billion. And then I was interested in something that Melissa said about the traffic acquisition cost. So essentially, how much Google pays to its partners to get us to click on an ad or get us to one of their services or one of their apps. So as Melissa said, $7.49 billion. That is actually slightly higher, which would be slightly more negative, meaning Google is paying more to get our eyeballs. That's really what it comes down to. And that, in fact, is a little bit higher, but not by too much. 7.46 is what analysts were looking for. The thing I'm also waiting for, Connell, in addition to this apples-to-apples comparison, so I give it to you straight, is also cloud. I am waiting for that. I think it's supposed to come in around $8 billion, which, by the way, would be twice its 2017 level. So if you look at Google, where does this company make its money? Search ads #1, YouTube #2, and then the third and growing division is cloud #3. We've heard that from the CFO, Ruth Porat, talking about that, and they kind of bury it in this quote-unquote other revenue basket. So I'm going to need to go through that as well. But that's the last metric that I'm working on, and I'll come back to you as soon as I have it, guys.
Fair enough. Thank you, Deirdre.
Sure.
Scott, back to your thought. I mean, my thinking right now, as the stock's at about 2%, is not great, right? I mean, the revenue, because as Doug said, we were looking to see how much above 40 do you get in revenue. You get to 40.5, and yeah, that is better than expected. But the costs are going up, so paying more for the clicks, and we'll see about earnings again. But it's not great, maybe not terrible, but not great. Stock now down 2%. Scott, go ahead.
True, but I think this sets up like an Amazon story from last week, guys, you know, where it's about the spend, you know, because the top line to me is pretty impressive. You know, we own Google in a lot of our portfolios. I'd look at EBITDA margin growth, too, to see what that percentage looks like. But I'll tell you, you know, aside from the cloud stuff that Deirdre mentioned, Google's clicking here, guys, and there's times, as we learned from Amazon, these companies do have to spend. They do have to throw some extra dollars out there to keep their dominance. And don't forget, as a lesson to us all, Amazon was down, what, 8%, almost 10 after hours, after earnings? And then on Friday, up all the way, and we were picking it up that day. We'll be buying Google tomorrow if it's down.
Very good, fair points. And let's, Deirdre, go back to you. What else are you seeing?
So you guys broke the number. It's exactly right. There is no adjusted earnings that I'm seeing. So it's $10.12 a share, and that was versus, as you've been reporting, Wall Street estimate for $12.42. And what I want to point out is even if Alphabet Google had managed to hit that $12.42 per share, that still would have been a drop of around 5%. So I think that's why we're seeing a little bit of pressure on the stock, although also worth pointing out, you know, it hit something like a 6-month high during the regular session. So this earnings figure, of course, disappointing.
But Deirdre, you know, we always talk about, you know, sort of the companies that are known for sandbagging and who beats. These guys, they've beaten earnings 7 times. Revenue estimates 6 times in the last 8 quarters, making it more significant that if they are to miss on that one number, which it looks like they are, that's pretty unusual for them, and it might make it more significant. What do you think?
Yeah, I think that is an absolutely great point to make. The fact that, they're usually pretty transparent. They're usually pretty on target. One thing that I remember from some comments, again, getting back to the CFO report, saying that CapEx would grow this year, but at a slower pace, and some of these other bets. Now, they do kind of put some other businesses together in a bucket, making it a little bit easier, or rather harder to go through. But Waymo, Google Fiber, the Verily Life, they have a lot of losses in that bucket. Now, I'm not sure that's enough to really disappoint on that earnings figure. But again, sometimes they put these things in buckets that I am currently going through. But at the moment, we do have the stock, as you can see for yourselves, moving lower in this post-market session.
Brings up something of an investment debate, because Scott brought it up already. So, Doug, I'll get your point of view on this. If the stock sells off tomorrow, so now say it's down by $40. So it's down 3.5% now.
Sure.
So is it something where you say, well, maybe Google's not what it was cracked up to be, I better be careful? Or are you on Scott's team here that maybe we get a buying opportunity if we get a little bit of a dip on an Alphabet?
Well, the stock is up double digits over the last quarter, and even if our outlook is about 1,400 for it, the upside from here is basically like a single-digit upside. And so a stock like this, when there's a lot of other opportunities elsewhere for double-digit plus upsides, I don't know if the risk is worth it to be adding at the levels when the outlook near term isn't so great. And that's the big difference for me.
Yeah.
Is I liked it when it was below 1,200. I like it less around 1,300. It's a little bit better. That's a much better price point for me because then I can get a double-digit upside. Why are we taking a whole bunch of risk if we're not going to at least be rewarded for that kind of an upside?
Scott, let me ask you.
There.
Are you going to be looking into what they have going on hardware? I mean, this is one of those things that they've tried over and over again, whether it's their phones or the speakers or the Wi-Fi routers. They keep trying to venture out into this area. You would think that something would be a huge hit along the way, but I don't know that we've seen that. Do you feel like this is still a worthwhile investment, that they have to get a toehold, or is it kind of good money after bad?
Well, it's a great point. Nest is another one, Melissa, that was out there that, those have worked out okay, but not as well, like you said, as they expected. Now, to me, I think there's other things, too, aside from hardware, and you're right about the phones. That's been a major goof. But I'll tell you, I mean, you look at Stadia, right, which is their gaming streaming that's coming on in November. Estimates of Stadia over the next several years are gigantic when it comes to revenues, and they think they're going to challenge Amazon. So there you have to watch what Google's got on, say, some of those other developmental platforms that Deirdre was hitting on that are probably aside from some of those hardware worries. I mean, guys, Stadia could be gigantic into the tens of billions if it works out, and maybe even the single billions if it doesn't. So those are areas, too, that they haven't even tapped into yet that still should be in the stock here.
What about Fitbit? I mean, that was the report today. I think it was Reuters had a report that Alphabet's ready to make this offer for Fitbit. Now, in addition to that, Doug, they already have they've already bought the intellectual property around Fossil smartwatches. So they had some IP there, so that Google has that. So what are they doing here? Is this a play to be the Google Watch versus the Apple Watch, or what do you think's going on?
It is. I like the Fitbit acquisition, actually. I think that's a plus. There are some negatives. There are some positives. What this is showing to me is it's showing the signs of a mature, large-cap growth stock. Not an aggressive growth stock that it used to be from some time ago. And that's it. That means it has a place, but does it have the same place to the same degree that it did? Is it a buy or is it just a hold? And that's the big difference for me, is I see some good signs, but there's a lot of negatives hanging around there, and that's the way I would look at it.
Good enough, down $40, which is about 3%. We'll be back to you guys. We want to get to Beyond Meat now. There's one we talk a lot about. Than something else. It has just reported its own results for the third quarter. Deirdre, you're a busy woman. Oh, boy, 7% to the downside. What are we seeing?
First profit as a public company. As we know, this company came public in July. But if you look 6 cents a share, Wall Street was looking for 3 cents a share. So you're going to see some positivity there. Although I do see it moving lower here after hours. And you do also, oddly enough, have revenue exceeding expectations as well. So not quite sure I understand the way that it's trading. But $92 million is what they posted for fiscal third quarter sales. Wall Street was looking for $82.23 million for fiscal third quarter sales. I do want to highlight, though, since the IPO in July, this stock is still up 300%. So you may have a little bit of coming down just from the fact that I hate to repeat these sort of cliches, but, you buy on the rumor, sell on the fact. We know McDonald's is testing out Beyond Burgers in Canada. We know that Dunkin' and Yum Brands, KFC, adding these kind of meatless additions to their menus. Also, some of their products have shown up in Subway, Pizzeria Uno, Bistro Bar, which is owned by Marriott. So they are certainly getting out there. The company also saying it is going to spend more on marketing. That headline coming through as well, along with the numbers. So as we can see here, some pressure after hours. But listen, it's a beat on the top and the bottom line.
No guidance on profits. It does provide some full-year guidance, and it's interesting here. If anything, Scott, maybe it's a little selling on the news. Maybe there could be more to it than that. But what have you been thinking, Scott Martin, about Beyond Meat?
Yeah, I mean, dare I say the stock, it probably got overcooked at one point or another. To Deirdre's point, there you go. I was waiting on that one. Thank you for throwing me the ball. To Deirdre's point, I mean, the stock is up 3x since the IPO and was up like 8x at one time. So, I mean, it went totally crazy. And the reality is they're going to see a lot more competition going forward. I think the product's great. I think it's got a great place in society. But the problem is they're not the only one. And as more of this stuff gets developed, they're going to get modularized.
I'm
afraid to admit, Melissa, I have tried it, but I did put bacon on it. I put bacon on the sandwich, which basically offset any benefit it had.
You can't do that.
You are complete.
Yeah.
Sorry. He's a fraud.
That is cheating.
He's a
that is cheating.
fraud.
You can't do that.
A complete and total fraud. I don't know. Doug, you want to make a point about Beyond Meat? Down 8% right now.
I like it when it's in the double digits. I didn't like it in the triple digits. I think it's better. I think there's the market itself, the demand for that expanding market is fantastic. To the point of it, they're going to face a lot of competition, and I expect a lot of volatility. You have the lockup expiring, where all the insiders, it's been 6 months, they can finally sell. That's going to put some downside pressure on the stock. There's going to be an increase in volatility. Not that there hasn't already been a bunch of volatility with it. But I think, you have to look at the space more than just this player, and there's going to be more coming in there. But I like the price. You always, with investing, you have to think of price points, right? Entry points. I don't want to pay over 100 for this because the upside is not that great in the near term. So it's a little bit more advantageous around this price.
You got it at $98 right now. All right, Doug, good stuff as always. And Scott, Beyond Meat with bacon. All right, thanks to you both.
See, I think that's